Hey everyone, Daniel Snyder here from Seeking Alpha. Thank you for tuning in for this hour of diving into six beaten down stocks ready to rally with Stephen Cress. Now, I don't know about you, we're going to dive into everything, but one thing that popped in front of my face this morning, as well as yours, were those PPI numbers. So I think Steve might actually touch on that here a little bit today and tell us what's going on with those numbers. Does the market care? Does the market not care? We're going to dive in during this hour, so stick with us. But first things first, let's go ahead and get a quick legal disclaimer out of the way. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, or strategy or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions, Stephen Cress's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results. Seeking Alpha is not a licensed securities dealer, broker, or U.S. investment advisor or investment bank. And we got that out of the way. Now, Steve, this is one of the, we were just talking about it before we started this webinar. This is one of those webinars that we love to do. No, the track record is proven as we put these little mini portfolios together throughout the year. This time it's 6 stocks, sometimes it's 10 stocks, sometimes it's 5 stocks. They tend to do pretty well. So I'm ready to dive in. But for the people that may not know who you are, can you give us a quick little background of how you got into the world of finance and where we are today?
Sure. And Daniel, thank you for organizing this today. So my name is Steve Cress. I'm the head of quantitative strategy at Seeking Alpha. I've been with the firm for about 6 years and actually acquired my firm, which was Cress Cap Investment Research. I've been in the world of finance for over 30 years. The bulk of my career was at Morgan Stanley, where I ran a prop trading desk in quantitative strategies. And I also founded a hedge fund at one point, which it was in quantitative strategies as well. So very strong background there, Daniel, in quantitative strategies. And yeah, I think this morning the market was a little bit unnerved by that PPI number. It shrugged it off later on in the day at a certain point, but I think the market took pause. And certainly, and we'll point out in the presentation, I think a lot of individuals are looking for an interest rate cut and a big cut at that in September. So I will tell you, if we have a couple more numbers like the PPI data that came out, we may not see that cut, but we'll have to see how it plays out and how the cards fall. A little bit about our
next week specifically too. Next week is Jackson Hole, remember? So everybody's watching now for the commentary from the Fed, and obviously with a PPI as hot as a summer in Florida, if you will. I mean, this is not a good setup going into it, but we'll see what happens.
Yeah, and normally, that Jackson Hole meeting, like everybody's waiting for it, and it's a bit of a snooze. Like nothing really comes out of it. But look, over the next few weeks, we're going to see more data points come out. And it is getting to that point where if you did expect inflation to start kicking in because of the tariffs, this is the point where it would start kicking in. Question is, are there enough offsets to it? The tax reform, will that stimulate the economy enough? Will that create inflation, if the economy is stimulated? So there's a lot to say. A lot of economists do feel with the tariffs that it will be a one-time type of event. So it won't have a long tail to it. Others believe, though, that it will have a long tail. So we'll just have to see how the data falls. So a little bit about our presentation today. I'll go over Quant a little bit. I'll review the pull and push factors that are driving the market right now. And then we'll dive right into the 6 beaten down stocks. And as Daniel said, we have a pretty good track record at highlighting beaten down stocks that typically are Quant strong buys. For various reasons, these stock fall. And usually it's a bit short-term oriented, that decline. And it's a great way to take advantage of stocks on the dip. So we'll dive right into it. Daniel, what is Quant? How do we achieve our results? Well, Quant is a data-driven methodology that is used for investment research. It's really not dissimilar to what a regular fundamental analyst would do at Morgan Stanley or Goldman Sachs. We do look at the core factors, which are value, growth, and profitability. The only difference is, and it's a big difference, when we look for those factors, we use the power of computer processing to identify all stocks with those factors, and we compare those companies to other similar companies. So it gives us the ability through that computer processing to assess thousands and thousands of stocks, where a single analyst typically really can only cover maybe 15 or 20 companies. And when they write research reports, they'll typically issue maybe 3 or 4 reports per stock a year. With Quant, we actually refresh those recommendations every single day. So we literally download millions and millions of data points. We refresh it, and every day we have a new directional recommendation. So it could be a strong buy for a long time, could be a hold for a long time. But if those data points change, being that we refresh it every day, we'll capture that change. And if there is a shift, it will be apparent in that directional recommendation. So not all quant is the same. Some quant models look just for momentum, some look just for value, some look just for growth. We have a diversified approach. We refer to a GARP methodology, which is usually referred to as growth at a reasonable price. And really, the core metrics that we try to identify are growth, value, profitability, positive analyst EPS revisions, and momentum. Those are the core factors that we look for in our model, and it has proven to be successful over time. In fact, we'll be able to show that to you. And the point of this chart is we don't have an ETF at Seeking Alpha or a mutual fund, but what we do is we monitor the performance of all our strong buys every single day. And any stock that's a strong buy, we throw it into a portfolio. If it falls out of the strong buy category, it comes out of the portfolio. So here we monitor our strong buys against the S&P 500. And really going back since 2010, we've outperformed the S&P 500 every single year. But more recently, and that's what's always important, people want to look at recent, our track record is very good in the last 52 weeks. The strong buys are up 40% versus the S&P, which is up 13.63% for the same period. And Wall Street strong buys are actually up 19.9%. So I will say it's actually fairly rare for Wall Street analysts to outperform the S&P 500. Over the last decade, the S&P 500 has handedly beaten Wall Street analysts. But I think being that the concentration risk that's been in the S&P 500 with Mag 7 stocks, that hasn't really played out this year as it has in past years. So it's given Wall Street analysts the ability to recommend stocks outside of the Mag 7, and they've actually performed fairly well compared to the S&P 500, but of course not nearly as well as Seeking Alpha's strong buys.
Steve, real quick, I want to jump
Yeah.
in because a great question just came in from Jeffrey asking, what is the difference between the quant ratings to the second Seeking Alpha recommendation versus, like, say, Seeking Alpha analyst, I guess. And the big thing that we want to communicate here is the Seeking Alpha analyst rating is the entire community of people writing on Seeking Alpha about the stock, and it's an aggregate rating of the last 30 to 90 days for that individual stock, where your system here is strictly data driven. There is no human bias. There is no analyst jumping in saying, well, I think a catalyst is coming. You are looking strictly at the fundamental data and comparing it against peers in the same sector every single morning. So just wanted to take a quick second to clarify that.
Yeah. So, and what I did is went to our platform so people know what Jeffrey's referring to. On the rating summary, you will see that there is the Seeking Alpha analyst consensus rating. There's the Wall Street consensus rating and the quant rating. These are 3 independent investment research resources. So you should look at it as 3 independent sources. And in this case, all 3 have a strong buy on this particular stock. But as Daniel mentioned, with the quant, we refresh it every single day. So if any of these factors change, it impacts the total quant score. And that quant score could change if there were a change in these factors. I'll take us back to our presentation, Daniel.
And that quant rating system runs every single morning before the market. So you always have fresh grades the
Absolutely.
day.
Spot on. All right. So pull and push factors driving the market. So we have a nice chart to the right side here, which is the July jobs report, which came in lower than expected. Some of the other data outside of that, we've had rising core inflation. Core CPI accelerated to 3.1%. It's actually its highest level since February 2025. So that was definitely concerning. We saw wholesale prices, or the PPI index, come in at 0.09, which just came out earlier today that Daniel was referring to. That was higher than expected. And of course, there are escalating trade tensions. Again, President Trump's new reciprocal tariffs triggered a 22% jump in the VIX and pulled major indices lower on August 2nd. The market did recover, but it's just beginning to show you that, it is people are getting a little bit nervous. So the market did, bring us back to a new high this morning. Definitely scared off a little bit, but the market adjusted to it. What's it all about? People are focused really on inflation and interest rates. And when it comes to interest rates, we look at what interest rate traders are doing. So I think this is really interesting. If you look on the right side, on the top, you'll see a bar chart, and that was just as of July 16th. And at that point, 56% of traders expected a rate cut in September. But since that point in time, if you look at it as of August 14th, we now have 90% of interest rate traders expecting a rate cut for September 17th. So, Dale, my belief is, and I think a number of market strategists really feel, one of the reasons why the market's going to new highs has to do with the belief that interest rates could be coming down. So, were we to see interest rates come down, that would satisfy the market. I would say if we don't see interest rates come down in September, and most interest rate traders are expecting that rate cut, and a lot of people who are investors have been expecting that rate cut, that could be pretty disappointing for the markets if we don't get that.
Steve,
And
I
as
gotta
you
say,
can,
the
yeah,
surprising thing for me is go back through history and look at every time that the Fed has cut interest rates when the market was at an all-time high, and it won't make you feel very good.
no.
So it feels like these upcoming data points are going to be watched like a hawk in the weeks ahead, and especially coming off of the wrap up. We're wrapping up earnings, right? The last big one
Yeah.
is Nvidia coming here at the end of the month, but earnings season has been great. So to the Fed, they're saying, why do I need to cut? So all eyes are on this in the weeks ahead, and it's definitely going to probably add a little volatility.
I think you're absolutely right. I think we'll add volatility. It's a very, anticipated rate cut. Could happen that you get the rate cut and then like the market already anticipated, so nothing really happens. Of course, the downside risk being that there is no cut, and then the market would be like, whoa, what's going on? So we'll see what happens. But I'll tell you what, as we get into the stocks, we really try not to pay attention to too many macro factors. We look at the data behind each stock, and that's how we make our decisions. So, as we were talking about a couple of the potential tripwires that could occur, there could be tariff fallout. There could be, as I said, the Fed's, a potential Fed surprise of delaying the cuts or no cuts at all. And as we've seen the market appreciate here, we are seeing equity valuations stretch out. And they are quite elevated versus our 5 and 10-year averages at this point. So, bottom line, really, I want to tell people, try not to pay too much attention to these factors. If the market does correct at some point, look at these stocks. The economy is still in fairly good shape. Corporations are doing a good job coming in better than expected with earnings. So that dip could really work towards your favor. Don't look at it negatively. But at this point in time, we already have some stocks that have taken a dip. In fact, we have 6 beaten down stocks that have strong buy recommendations, and that's what I want to highlight here today. So our first one is Finvolution Group, ticker symbol FINV. Now, this won't be for the faint of heart because this is actually a Chinese company that we're highlighting. But in terms of looking at the core data, when you look at valuation and growth for the company, it ranks number 3 out of 38 within consumer finance. And the financials overall rate, it ranks 8 out of 691. As I mentioned, it's a China-based fintech company that connects borrowers with banks and other financial institutions. So we're looking for stocks that have dipped. This one is down 16% month to date, despite really surging expansion and a very, very powerful AI marketing tool for this company. I'm going to take us actually into the platform. So we're going to go to Finvolution. As I highlighted before, our 3 independent sources here being Seeking Alpha Contributors at Wall Street and Quant all rate this stock a strong buy. So it sort of hit the trifecta of strong buys. I mentioned on the month, it's down 18% at this point, adding another 2.43%. So continuing with that downward trend. So why do we like this stock? First off, on valuation, it gets an A+. This stock is dirt cheap versus the rest of the financials. If you look at the forward PE on it, as I mentioned, it's an A+. The forward PE on the stock is 5.49 times. The sector is at 11.9 times. So the stock is at a 50% discount to the sector. So on a forward PE basis, It's very, very cheap versus the sector. If we look at some of the other factors, such as EV to EBITDA, EV to EBIT, it's got straight A's across the board. If we look at price to cash flow, it's an A minus, 5.18 times versus the sector at 9.7 times. Very cheap. So it's definitely attractive from a valuation standpoint. If we look at it from a growth standpoint, it has a B minus, but we will see if we look at EPS diluted growth forward. So this is using consensus estimates from analysts, taking the forward growth rate. They have a growth rate of 17.5% for the company versus other financials at a growth rate of 9.9%. So the growth is at a 76% premium to the sector. And again, this is forward EPS growth. This is not looking at the historical. The year-over-year number was 26% versus the sector at 12%. But when I look at growth, I like to look forward. So we're looking at forward EPS growth using the consensus of Wall Street analysts, and they have 17.5% growth rate. So that is a very strong growth rate for the company. In terms of the profitability, if you look at our return on equity, which I always look at for financial institutions, it's at 17.8% versus the sector at 10.68%. So it is a 67% premium to the sector for return on equity, return on capital with an A plus, return on total assets with an A plus, and even the EBITDA margin is an A at 54%. So the company really looking strong across most of the metrics, almost a straight A. The growth is a little bit lower with a B minus, but still incredibly strong. So that's Finvolution, ticker symbol FINV. Back to our presentation, Daniel. And our next stock is Sezzle. So we came out with this recommendation actually recently for one of our portfolio products, PQP. And boy, the stock got hammered almost right away, which doesn't happen often, but it does happen. So reviewing the stock here, Sezzle has a market cap of about $3 billion. And this is in financials as well. And in the sector, it's 26 out of 691. So not as high as the previous election, but within its industry of transaction and payment processing, it ranks number 1 out of 41. This company's business is payment solutions provider, and it has really gotten hit hard. I'm going to take us to the platform. So we're going to look at Sezzle here. And you can see over the last month, the stock is down 32%. So getting hit quite hard. And Daniel, I will tell you, they came out with their numbers on August 7th, and they beat expectations. They beat both top line and bottom line. So there was a nice beat there. So it was a bit of surprise that the stock came off so sharply. There was a short squeeze on the stock recently. A lot of people feel like it's a little bit of a reversion to the mean with the short squeeze. If you take a look at the stock year to date, you can see it's up 114%. So the fact that it's fallen over the last month by about 32% is pretty small in comparison to the increase that it's had on the overall year. So that short squeeze is starting to unwind. But a lot of people believe because of that squeeze, the stock really ran up. So a bit of a reversion to the mean. Again, they beat their estimates. Seeking Alpha contributors do have a hold on it, but Wall Street coming in with a strong buy and a pretty strong buy, very, very strong buy at that, with consensus. If we go down, you can see there are 3 professional analysts that cover the company, and they all have a strong buy on the company. If we were to look at the growth, we can see it's an A plus. So Sezzle, year over year, the growth was 146%. And then if we look at the long-term growth, and this particular factor here, which is EPS forward long-term, using a 3 to 5 year CAGR. So that's analysts going pretty far out. They're looking for this company to grow at 245% versus the sector at a mere 10%. So that is a huge, huge growth number for this company. So there are high expectations from professional analysts. If we're to look at the valuation for the company, we can see it is a bit expensive. Overall, it comes in at a B minus. And the reason why it's a B minus in the face of the PEs, which come into the D category, is the PEG ratio, Dale. So you can see the PEG ratio is an A minus. This is a very strong predictive factor PEG. You can see that, and the PEG, for those who are not familiar with it, it's a great factor because it actually combines the growth rate with the PE valuation. So it really puts the valuation in perspective of a company's growth by tying the two together and blending it. And you can see on a peg basis, on a forward peg basis, it's 0.11 versus the sector at 1.27. So in terms of this valuation metric, it's at a 90% discount to the sector. So it's really quite telling when you combine that growth number in with the PE. So on an absolute PE basis, yes, it does look expensive. But if you take that PE and you combine it with growth, it looks quite attractive in terms of profitability. We're looking at an EBIT margin of 56% versus the sector at 22%. And we're looking at an outstanding return on equity, absolutely huge, at 115% versus the sector at 10%. And again, as I mentioned, when I look at financials, I really do like to look at return on equity. And that is a very, very strong number. So Sezzle, ticker symbol SEZL. Again, this stock was really doing quite well up until the last month. And the last month, the stock has come down 32%. But again, that's in light of the stock being up 114% year to date. Could have something to do with that short squeeze.
This one's interesting to me, right? Because we do these webinars all the time and we present stocks, and a lot of people are like, well, why do I buy at the 52-week high when it stock's at all-time high? So this one for me, I think I'm going to personally put on my watch list and keep an eye on it, because either this is a great buying opportunity with that pullback, especially with, like you were mentioning, beating earnings. And if you go into the earnings call, like I was just kind of using the earnings AI feature we have here on Seeking Alpha, looking over the transcript and stuff, it looks to be a lot of positives. So might be one of the market shakeup moments here with this stock. That's an interesting one, Steve.
Yeah, and I'm actually glad that you mentioned like looking at the stock now versus a while back. If you look at the valuation grade, you can actually see the valuation grade now is a B minus versus 6 months ago was a D minus. So, despite the stock rallying 114% year to date, the stock actually has a better valuation framework now than it did 6 months ago. So I'm really happy that you cued people into that, because it's a better valuation framework now than it was back then. All right, back to our slideshow. All right, our next stock is a REIT, which is Host Hotels and Resorts, ticker symbol HST. This is a big company, a market cap of 11.21 billion. Within the real estate sector, it ranks 4 out of 175. And within its sector of hotels and resorts, it actually ranks 1 out of 15. This is a global premier REIT. It's down 3.9% month to date, despite a double beat, which was reported on July 30th. So beating both top line and bottom line. Some of the attractive features here, AFFO growth is 54% versus the sector at 4.6%. And the AFFO payout ratio comes in at about 55% versus a negative 25% for the sector. That's crazy. They have a tremendous amount in cash at 1.43 billion and cash from operations, huge premium to the sector. And the dividend yield at 5.59% has a dividend safety grade of an A. So I'll point that out. If you look to the right, you can see the dividend safety grade is an A. Typically, any company that we recommend that has a dividend, if that dividend safety grade falls between a B minus and an A plus, it's historically has shown to be a very, very safe dividend. The territory that you want to watch out for is any dividend safety grade that's F through C minus. So being a dividend with a dividend safety grade of A, I think most people can expect to rely on that dividend. Our number 4 stock is Oddity Tech. So this is actually not a tech company, although it kind of is. It's within the consumer staples sector. Market cap is 3.3 billion. It is a quant strong buy. Within consumer staples, it ranks 1 out of 178. And within its sector, personal care products, it ranks 1 out of 10. This is a direct-to-consumer beauty company operating exclusively online, hence the technology component to it. Recent post-earnings sold off due to slightly disappointing Q3 margin. So I'm actually going to take us to our platform on this, and we're going to go into Oddity. So you can see
that
the stock came off sharply here.
Even JP Morgan put out their own little release about their 20% sell-off here. But that's what we're talking about, the 6 beaten down stocks. This one's beaten down.
this one is beaten down, and hopefully it's going to be a good opportunity. The consensus from our CT Alpha contributors is a buy. Wall Street consensus is a buy. The Quant has a strong buy in the stock. The valuation, I will say, is a little bit expensive on this one. So when we look at the factor grades, I want to highlight to you these factor grades are all sector relative. So when you're looking at this company within consumer staples, and you look at these core investment characteristics here, you can see these grades indicate it gives you sort of an instant characterization actually of how it compares to the sector. So versus the sector, it's a little bit expensive, but the growth versus the sector is an A. Profitability versus the sector, B plus. Momentum and revisions are A versus the sector. But really within one click, you could take a deeper dive. So when I say valuation is expensive and we click on it, you will see by looking at the PE and EV to sales what the grades are. But again, what brings it up a little bit, Daniel, is that PEG ratio, that forward PEG ratio coming in at an A. So if you were to look at the PEG ratio, the valuation framework actually looks inexpensive using that one metric. If we were to go to growth, it looks pretty darn good. If you look at the EPS diluted growth going forward, it is a 21% growth rate. Consumer staples has a growth rate of 5.89%. So this is at a huge premium in terms of growth to the sector, and that's absolutely what you want. So whether you're looking at EPS on a diluted basis or EPS on a GAAP basis, it's way stronger than the sector. And then if you look at one of the metrics I like to look at, the EPS for long-term 3 to 5 year CAGR, that's a tremendous premium to the sector as well. So you're not going to find many consumer staple companies with this kind of growth rate. So as we saw from that PEG ratio, it's kind of worth the valuation. Again, this ranks number 2 out of 31 within personal care products and number 13 out of 178 for consumer staples overall. But I really do like the way this company looks. If we go to the summary page,
Steve, I was just looking at the earnings here because they just announced as well. They raised both their net revenue guidance and their profit guidance going into the fiscal year. So obviously they
yeah.
see something that we don't know.
And as you mentioned too, Oddity 20% sell off defies the numbers JP Morgan. So the numbers look great. And short interest was a bit high in the stock, coming at 13.2%. So, part of that run up that we could have seen, I'm not completely sure, but that could have been a short squeeze. So maybe after the numbers, a little bit of a reversion to the mean usually ends up being a great buying opportunity for people who are not short this stock. So taking us back to the slideshow, going to stock number 5, another consumer staple company. This is a European company, Henkel, ticker symbol HENOY. This is a really big company. Market cap is 32 billion. Currently within consumer staples sector, ranks 11 out of 178. And within its industry of household products, it ranks 2 out of 13. It is a German conglomerate specifically, serving both households and industrial markets. The share price slid due to disappointing Q2 earnings release. So it is a consumer staples company. So sometimes you can miss by a penny or two, and it can take a stock way down, especially within consumer staples. But this company, for the most part, is, as I said, it's tremendous. And I will actually take us to the platform so we could see what it looks like with the numbers specifically. So valuation is attractive at a B versus the sector. Let's take a look at the growth. So I think what's important with the growth is if we look at the EPS forward growth rate, Wall Street consensus. Again, Daniel, this isn't my estimate for growth.
Right.
This is actually Wall Street consensus. They're looking at earnings growing at a rate of 24% versus the sector at 8.28%. So that is a huge premium to the sector. Part of what we're seeing is that the year-over-year growth rate was 53%. So it's slowing down to a forward growth rate of 24%. I think maybe that got realized recently. So the stock took a little bit of a dip, but even at 24% growth versus the sector, that is absolutely tremendous. If we were to look at the profitability for this company, it's fantastic. The gross profit margins are 50% versus the sector at 36%. And the EBIT margin is 14% versus the sector at 9.5%. So looking, really nice against the sector. And a number that really sticks out to me is actually the cash per share. So you can see it has an A grade versus the sector. This company has $8 per share in cash versus the sector at $1.83. So there's a tremendous amount of cash in this company. It is a stalwart, and I think it's probably taken as much of a hit as it's going to take. You can actually see starting, the beginning of August, the stock has actually started to rally back to about $20. However, it was at around $23 and it's come off a bit. So it could be a really nice opportunity to get these shares while they're a bit weak. I will also highlight, should something go wrong in September when, the Fed should be cutting rates by the estimates of our interest rate traders, as high as a 50 basis point cut. If that doesn't happen, this will be a good stock to own during that period. All right, back to the slide deck, and drum roll, please, for stock number 6. Brinker International. So you might be familiar with that. We have, for the most part, had a stellar experience with Brinker, ticker symbol EAT. Having said that, in recent weeks, this stock has come off. This is a consumer discretionary company ranking 40 out of 477. However, within the restaurant industry, it ranks 3 out of 43. And you might know them for their brands, the biggest one being Chili's. The stock's down 5% month to date, despite strong sales coming in from this Chili's franchise. This was an alpha pick stock, which is one of our portfolio advisory products. The stock was up over 200% since it was selected in alpha picks in April of 2024. The numbers looking really good for this company, despite the stock coming off recently. So we're going to go to the presentation, to the platform. You can see it's actually up a little bit today. Almost 0.5%. There was an earnings call coming out on the stock. Brinker targeting 5.6 billion to 5.7 billion in revenue as Chili's momentum accelerates, and Maggiano's, which is their Italian restaurant, continues to show leadership in the category. You can see over the last 1 year, the stock is up 152%. And Daniel, even with that stock being up 152% over the last 52 weeks, the valuation is unchanged. So that really tells you that this company has very, very strong growth, that the valuation could be the same amount now that it was 6 months ago, and yet the stock is up so much during that period. And the year to date, it's up about 19%. But if we look at it over the last month, it's down about 5%. So we would look at this as a buying opportunity. If we click on growth here, A+ for growth, you could see really, just see 1B, and that's actually the forward revenue growth, which is 10% versus the sector at 3%. If we're looking at the EPS forward growth rate, Daniel, it's an A+. Wall Street consensus is for this company to grow at 51% versus the sector at 6.83%. So you can see why we like this stock so much. Just tremendous growth. And if we go to the valuation, the PE actually looks really attractive on this company, with a multiple at 15 times versus the sector at 17 times. And then, of course, the PEG forward being an A+ at 0.36 versus the sector at 1.84. So this company has just been fantastic. It's been great for alpha picks. It's been a great overall recommendation. It's a quant buy now. It's not a strong buy, but still looks really super strong on growth and a valuation framework that is very, very compelling.
And the board just authorized an additional $400 million in share repurchases. So keep that in mind too. Companies that are doing bad don't do that. So we got a nice little support from the company to keep reducing that float for the rest of us.
Yeah, so Daniel, that I appreciate highlighting that. And that brings us to the end of the 6 stocks. Here's a little bit of a recap, pulling it from our portfolio tool. You can see all the stocks a strong buy, except Brinker, which is a buy. But of course, Brinker having just tremendous growth, but a lot of green here for our grades and our report card on these companies. So most of them looking really strong. Oddity coming in with the only D for valuation. But as I mentioned, that PEG looks super strong for Oddity. So overall, I think there's some great buying opportunities with these stocks that have taken a dip. I also am going to have an article that's coming out today, 6 beaten down stocks ready for a rally. So that article will go over these stocks in a little bit more depth. So keep an eye out for that article. And if you have the chance, please follow me and you'll get all my articles sent to your email. So Daniel, that kind of brings us to the end. I mentioned a couple of our portfolio advisory products. We have two that we created at Seeking Alpha. One is the Pro Quant portfolio, which is only available on our Pro platform. The platform I was just showing you, we have two platforms at Seeking Alpha. One is Premium and one is Pro. And then we have Alpha Picks, which is a portfolio advisory service. We actually just started the Pro, which I refer to as PQP. We just started that back in June of this year. And as you can see by the return on the left-hand side, from May 30th to August 14th, the average return is already 27.78% versus the S&P 500 on an equal weighted basis, 6.1%. And the reason why I use the equal weighted benchmark there is our Pro portfolio is an equal weighted basket of 30 stocks. It is actively managed. So we rebalance that on a weekly basis. So every Monday, you will get emails, or you can go to the platform and you'll see what the new recommendations are. We have on average 2 to 3 new recommendations on a weekly basis. So if you're looking for a more aggressive platform with a higher frequency of ideas, the Pro Quant portfolio could be suited for you. And as I mentioned, it's had a fantastic return since we started, really as of June 1st. And then we have our more seasoned product on the right-hand side, Alpha Picks, which we started about 3 years ago. And you can see the returns for Alpha Picks have been absolutely tremendous as well. Over the last 52 weeks, Alpha Pick stocks are up 43% versus the S&P up 18%. And the year-to-date return on the far right is 21% versus the S&P up 10%. Alpha Picks does not have that same high level of frequency with introducing new ideas. We just provide 2 of our top quant ideas every month. On the trading date closest to the 1st of the month and the 15th of the month, we send out an email or we put on our platform for 2 top stocks. So again, one having just 2 stocks a month and the other being a portfolio of 30 stocks that we rebalance on a weekly basis that has a higher frequency of ideas. As you can see, the performance of both of them, it's been absolutely excellent. Dan, let me pause there for questions.
Yeah, we're going to dive into Q&A, but real again, I just want to double down. Everybody, if you haven't already, go follow Stephen Cress's author profile on Seeking Alpha. You'll get the article about the 6 picks that we just went through today here on this video, on this webinar. You'll also get all of his other research that he is constantly putting out that we just can't keep up on the webinar front. You're just crushing giving stock ideas and different themes and things that might fit those portfolios. So, and also congratulations on Alpha Picks. I know recently the portfolio returns crossed over 200% since inception. I mean, I've been doing this with you since the start. So it's awesome to see how far we've come since it was launched. But yes, Pro Quant portfolio is more for that active investor that wants to be in and out of stocks, trading a little bit more frequently. And Alpha Picks is that 2 to 3 stock picks per month with just a few cells. And all of that gets emailed and push notification. Like, you are very on top of the communication, you and the team over there. So can't thank you enough, Steve. But with all that said and out of the way, everybody check out the links below the video if you're watching the replay or if you're in the chat. Let's get into some Q&A, shall we? And do me a favor real quick. Why don't we scroll back to the slide that had the 6 stocks just listed together? Because I know there were a couple of requests that people wanted to just get another snapshot on that here. And we'll start off with the first question, which came around FINV when you were talking about the Chinese angle, right? Some people are very weary about Chinese stocks. We don't know if we can trust data. There's all this stigma around that. So are you worried about that at all when you're looking at the quant system and how it rates Chinese companies?
I would say that the point of quant is to try to eliminate emotional investing, and that's why it works so well. I don't get caught up in many of the stories that you hear. Some of those stories end up being true. And, with the larger portion of companies, it ends up not being true. These are real companies that make real money and they have incredible growth rates. So there will be the occasional company that comes along that does blow up. It happens to the quant system, and it happens to, people who do speculate in stocks that don't have real earnings. But I will say, again, this is a data-driven process. All the data that we get comes in from the SEC, and then it gets scrubbed by S&P Global, so it gets standardized. So there are 2 layers that it has to go through before we get to the numbers. So for the most part, Dale, I try to eliminate those concerns. Does happen every once in a while, but I think, we have done very well with a number of the Chinese stocks that we've recommended. So again, I let the data speak for itself.
Well said, Steve. And I'm just going to answer this one real quick. So people are wondering, how can I track when the rating switches from, say, a buy to a hold or a sell? Well, if you take these 6 stock picks that we've gone through today, create a portfolio here on Seeking Alpha, whether it's in your premium account, if you're a free account user, pro account, put it in a portfolio and you can turn on those rating alerts so that every morning, once the Quant system is done running, you'll get that email notification saying, hey, the Quant rating has changed. And that way you can always stay on top of what's happening with these picks. Leading me to the next infamous question, Steve, is people want to know, when the rating drops down to a hold, what do we do?
You hold. So we, as I mentioned, we have our product Alpha Picks, and when a stock drops to hold, that's been a strong buy or buy, we actually keep it in the portfolio for 180 days. So we really do mean hold for hold. Typically, by rule of thumb, if I have a stock that's been a hold for 180 days, I'll probably make room for a new stock after that. But a lot of times when a company drops to a hold, it could be because the valuation grade has changed and the growth could still be very strong. The profitability could still be very strong. So sometimes it's just a matter of that next earnings upgrade. And when earnings get moved up again, the valuation becomes more attractive. So it's often a wait and see period when it becomes a hold. But when you know to sell stock when the rating is sell or strong sell, that's when you absolutely know to sell it. And again, if you're holding a stock for a long time and it hasn't done anything and it's got that hold, it's up to you really to make that decision if you want to make room for new stocks. But for us, hold means hold.
Well said. Thank you, sir. All right. So we had a question from Rob. It says, how long is the forward growth rate? I guess they're asking, how far in advance is it projecting? 1 year, 2 year, 5 years?
So our forward growth rate, we actually look at a couple of years. We're taking a look at typically actually one actual year and 2 years forward. And often actually what we do is sometimes we have one historical year in there as well. We like to have a really good segment of growth. We don't want to pick just 1 year. A lot of analysts will sometimes just look at one forward year. To me, that's a little bit riskier because there could be some type of outlier that impacts a stock for just one forward year. So we go out over several years. And actually, I can show you specifically, if we go to Sezzle, let's take that as an example. We'll click on growth and we're going to go to, I want to show you 2 things. So let me pick, actually, I think Henkel might be a better recommendation here. So we're going to hover over the growth rate. And you can see when we hover over it, this is a great tool at Seeking Alpha. You can actually see we'll give you a definition. So as I mentioned, there's one historical year, one actual year, and then 2 fiscal years forward. So you can hover over any of these metrics and we'll actually give you what the definition is right there. So I think I was being a little bit cagey there, Daniel. Sometimes I like to think that's really kind of proprietary, but we do share it with people.
Yes.
The way we look at growth for companies is different than most other analysts. We are combining one historical year with an actual and 2 forward years, but that's part of our secret sauce. Just don't tell anybody. So.
Yeah, no worries. I mean, there are the metrics that we don't show on the site that we don't. So there is the proprietary behind it. All right, do me a favor real quick. Since you're on the site, can you go over to Brinker International real quick? I want to show
Absolutely.
the question that came in. Somebody was asking about when I guess I referenced the earnings call AI. I just want to highlight right there. If you scroll down for the news section where you see earnings call insight, guys, this is a really cool feature for all premium pro subscribers. The earning call is this AI read through that not only goes through the transcript and the call of the actual earnings call when it's being done, but then also compares it to the quarters beforehand. And it even notes, like, was there a change in tone? Did management say something last quarter that wasn't correct, like they corrected this quarter? Like, really, really cool feature here on Premium Pro. Highly recommend anybody that goes into diving deeper into the earnings, use this feature. It saves you a ton of time.
And
Sorry,
Dale, I will tell you as a quant, I usually don't really listen to management teams.
I know
I
you don't.
love this feature. I love this feature. Like, absolutely love this feature.
This is where I'm the bridge, right? You're the math, you're the quant, and then I'm with everybody else where we still listen to analysts and track news and try to find catalysts, and this is what makes it fun. All right, here we go. So going into the next question here. The ratings updating. So Quant rating is updated every day. How frequent are the other two ratings updated? So the Seeking Alpha analyst rating, if there's new analysis published on the site, that will be updated as well. And then Wall Street analyst ratings, correct me if I'm wrong, Steve, are just updated when the Wall Street analysts update their ratings, correct?
Yeah. So, what if you scroll down on the page, you can actually see the Seeking Alpha and Wall Street ratings, how many strong buys there are, how many holds, how many buys for both the analysts on Wall Street and the contributors at Seeking Alpha. So when that number begins to change, so say by example, you were seeing a situation where those two buys for the Wall Street became strong buys, and then it had a total of 6 strong buys. That as that happens, the system updates itself on a daily basis. So if these numbers were to change, and have an impact on the overall consensus, that change would happen as it occurs. But of course, Wall Street analysts aren't changing their estimates, that much. They tend to do it maybe 2 or 3 times a year. Our contributors follow companies closely, but even with this company, there's only one contributor that follows it. I think if we take a look at a company like Brinker, that's probably going to have a bigger group of people following it. So if we scroll down, we could see that there are a total of 7 Seeking Alpha contributors that cover it and 19 analysts on Wall Street that cover it. So as these numbers change, the overall consensus would change as well. So that does get updated on a daily basis, but there's just not a high level of change that normally occurs.
All right, well said. And then there was a question that came in about Alpha Picks. I want you to answer that if you don't mind.
Sure.
They were wondering, is Alpha Picks designed as being more of like a growth kind of pick play, or is it value picks, or is it a mixture of both? What's the answer there for this person?
Yeah. So let me just take us back to the slideshow. So really, whether you're looking at Alpha Picks or the Pro Quant portfolio, our core focus, as I mentioned, is sort of like a GARP strategy. It's growth at a reasonable price. We do look at momentum and we look at analyst EPS revisions as well. So I would say, the difference is Alpha Picks is designed for longer term investors that just want a few ideas a month. They want, many of these investors who are members of Alpha Picks, they are engaged, they are sophisticated investors. But what they like about Alpha Picks is we've done the research for them, and they're just typically not buying a lot of stocks every month. So here they can get, 2 stocks handed to them where the research is complete. Where with a Pro Quant portfolio, it has a fixed portfolio of 30 stocks, and we do the rebalance on a weekly basis. So on any given week, you could have 3, 4, 5 new recommendations. Some weeks you may have no new recommendations. So it's just a higher number of ideas coming out of more of a frequent pattern than you would find with Alpha Picks.
Steve, this is a nice comment from Andrew. He chatted in here and he says, I regret not listening to you on April 4th when you recommended app, CRDO, CLS, and NVMI. So just a nice little word here. People are listening to you and tracking these picks. So here in a few months, I'm sure people will be circling back on these 6 that you shared with us today. All right, let's go in. And then PQP, people are wondering, you were talking about 30 stock picks. Could you elaborate more on the product? Is it we buy all 30? Is it ideas? What is the full value of PQP?
Yeah. So, whether you're looking at Alpha Picks or PQP, we're providing you with investment research. So with PQP, it's a portfolio of 30 stocks. And I look at it as 30 investment research ideas that we're putting forward. It's really up to you as an individual. Since we don't know what your risk tolerance is, we don't know how much capital you have, you could buy all 30 stocks and try to track all the changes whenever we sell stocks or buy new stocks. Or you could just look at the portfolio and review some of the ideas. So by example, there could be a couple Chinese stocks in there. Maybe you don't have the risk tolerance to have those Chinese stocks, so you'll avoid them. Or maybe, you believe that there could be certain sectors that are overvalued and you want to avoid those sectors. So you might choose to not own stocks in those sectors. So it's really up to the individual and the choice that they make. But a lot of people who are PQP subscribers do want to own all 30 stocks. we're definitely a big proponent of diversification, and that diversification helps to minimize your risk and it maximizes returns over a long time. So we do like the concept of, buying all 30 stocks if you can and just managing the portfolio from there.
All right. So we had another question here. How do you expect these stocks to react if there's an overall market pullback?
So typically what happens with the quant stocks is they have performed quite well for a period. When the market goes into a corrective phase, there's usually a rotation to defensive stocks. So people will sell stocks where they've made money. For that matter, they'll sell anything because of what they want to do is they want to own consumer staples, they want to own gold, they want to be in cash, they want to be in utility stocks. So pretty much, stocks that are in any other sector or stocks where they've had a good profit, they sell them to make that rotation possible. And what we find is historically that these stocks do sell off in that initial phase of a correction. But what we also know historically is that is an ideal time to buy our quant strong buys. So Daniel, by example, we actually did a study recently where we looked at the five most recent corrections going back to 2010, where the S&P 500 was down more than 15%. So going back to 2010, looking at those five corrections, just if you bought the market alone, when the market, even if the market went down 20, 25, 30%, if you use that point where of time where the market was down 15% and you bought the S&P 500 when it was down 15%, on average, you were up almost 50%, 50%, 2 years later. Using the same type of logic, if you bought our 10 highest ranked quant strong buys when the overall market was down 15%, and in many of those instances, when the market's down 15%, the quant strong buys are down maybe 20, 30, 40% during that period. If you bought those 10 quant strong buys at that point and you held it for 2 years, on average, they were up 117%. So I think that's a great question. Market corrections can be your best friend if you have the courage and the discipline to ignore the talking heads and use that as an opportunity to buy stocks that have really strong fundamentals.
Spoken like a true quant. Listen there. Get your emotions out of your head and go buy the stocks.
Do not listen to the talking heads.
Do not listen to the headlines. That's right. I mean, that's what gets a lot of us, right? I'll admit it. I'm human. And that's the cool thing about the Pro Quant portfolio. It's all systematic. Which, speaking of, there was a question that came through that asked, with the Pro Quant portfolio, it's about the hold rating. So Alpha Picks and Pro Quant portfolio kind of handle the hold rating a little bit different. I
They
think you
do.
mentioned Alpha Picks hold for 180 days. Pro Quant portfolio, do you sell the stock when it gets to a hold, or do you hold it?
We do not sell it right away. That data point I won't disclose. I know we do disclose it for Alpha Pix that it's 180 days. That is a bit of a proprietary data point. So we do hold on to it for a certain amount of days. It could stick around in the portfolio. It might not stick around in the portfolio. Whereas if we had a sell or a strong sell, that would be removed from the portfolio immediately. With a hold, that's not quite the case.
All right. And I know we're coming up here at the top of the hour. There was a couple questions about how to set up those alerts again. So I'm just going to remind everybody, if you put all of these picks inside of a portfolio, there is a button at the top of the page that says manage alerts. If you click on that, you can set up the portfolio digest and get alerts about rating changes for any of these stocks that we went through today, as well as any other stocks, right? So Steve, if you're going to jump over to the platform, maybe we can highlight this real quick so everybody can just be aware.
Yeah, so I'm going to pick something like
It's super important that everybody turns this on. I mean, it's one of the easiest and
here's
best hidden features.
Berkshire Hathaway. So here are their top 15 holdings. I have it into a portfolio. And Daniel, tell me what tool you
So
want me
at
to
the top, right there, manage alerts, you can click on that, and then that will bring up a whole dialog where you can get the email or the mobile push notifications. You can set up the quant alert, the Seeking Alpha analyst alert, the Wall Street analyst alert right there. You can set a price alert if you want as well. So a lot of custom ways to just make sure that you're receiving those notifications, but make sure you turn those on for the portfolios that you create. And then also just put these 6 picks in a portfolio and you can track it in the months ahead, just like I'm going to be doing this as well. But Steve, let's go ahead and wrap it up here. This has been a great webinar. Thank you so much for taking the time, doing the research. Everybody go follow Steve. We're about 4 minutes away here. That article is about to go live on his author profile page here on Seeking Alpha. And anything you want to say to people, Steve, before we get off in this crazy couple of weeks ahead?
Yeah, no, I just want to thank everybody for their time today. Please follow me if you can. And if you've been following me, we really appreciate your subscriptions to Seeking Alpha, whether it's premium or Alpha Picks or Pro. And hopefully you found our guidance has been working well for you. Thank you.
All right. And everybody, if you have questions, if you can't find certain things on the site, please reach out to us. Subscriptions at seekingalpha.com. That's subscriptions with an S on the end of it at seekingalpha.com. Everybody's blowing up the chat saying, really, really great. Great, Steve. You're the best, Steve. Awesome.
Thank you.
Everyone, we look forward to doing another webinar here soon. Everyone take care and enjoy tomorrow as we wrap up the week. Take care.